Hi, this is Brandon Christy from Christy Capital Management. Today I'd like to address some concerns about the recent market sell-off. Since reaching new market highs in mid-September, financial markets have been affected by global uncertainty and decline. I want to discuss some of the factors behind this recent sell-off and give you some insight into how these declines fit into historical market patterns. Please stay tuned at the end for a required disclosure statement. First of all, I want to acknowledge that volatility and market declines are very stressful. It's hard to keep calm when you see your account value go up and down. However, it's important to keep in mind that market corrections are a natural and normal part of overall market cycles. Since 1928, the S&P 500 has generally experienced between 3 and 4 corrections of more than 5% each year. This most recent pullback was the 20th decline of 5% or more since the bull market began in 2009. Many analysts predicted a pullback this fall. Between the beginning of 2013 and September 19, 2014, the S&P 500 gained over 43%. This recent market decline was largely because of fears surrounding recessionary pressures in Europe, slowing growth in China, Ebola, and some negative domestic economic reports. However, the good news is that economic fundamentals remain strong and the sell-off is mostly fear-based. Though the S&P 500 lost significant ground, it's still up by over 8% over the last 12 months. Looking further back, the S&P 500 is up over 75% since October 2009. How far stocks decline during a sell-off depends on a lot of factors, including investor sentiment, corporate earnings, and future growth prospects. In this case, markets are largely moving because of fear, not because of fundamental factors, so we can hope that this sell-off will be brief. Although global worries still exist, equities halted their slide and regained ground on the strength of positive earnings reports. This willingness to respond to good news gives us hope that investors will soon move back to optimism and buy the dip. Though market sell-offs are almost never welcomed, I want you to remember that they are a natural part of market cycles and it's important to take them in stride. As professional investors, we learned to seek out the opportunities in market volatility and correction. While we don't engage in short-term speculation, we do use sell-offs to find tactical investment opportunities. Market declines also give you the opportunity to really test your risk tolerance and make sure that your financial strategies are aligned with your long-term goals and attitudes about risk. It's very important to stay calm and not panic. While we can't use the past to predict the future, history shows us that staying calm and patiently waiting out the brief rough patches often benefits us in the long run. Above all, I hope you found this video to be educational and reassuring. If you have questions about how you're invested or how recent market investments may have affected your portfolio, please give us a call at the number below. We're happy to help.
While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision.